you trade based off of market structure, some other form of smart money concepts, you're probably making at least one of these 5 trading mistakes. They're causing undue stress, they're causing frustration and losses, they're appearing over and over again. They're calling aloud for remedy, right? And the good news is that even if you're making these, or even all 5 of them, you're not actually a bad trader, right? Your system's just giving you feedback because it wants you to grow into the trader that you're dreaming of becoming, right? Now, the good news, or at least the better news, is that once you usually fix one of these, the other 4 almost disappear entirely. They don't become factors as you're looking at the market through a bit of a different lens, or at least becoming more patient for one of them, and now the rest of them kind of sort themselves out. My name is Kevin. I'm one of the founders of The Bullpen, where we create consistently profitable traders by teaching them how to make consistent decisions in the market based off of price itself. And then we typically align ourselves with what we expect price to do next, right? So let's hop into these mistakes. Let's work through them. And we'll start obviously with mistake number 1, trading against the current objective.
All right, so diving right in. Now, what do we mean by that? When we're talking about objectives, usually we're talking about narrative and why the market is trading up or down to specific areas. Structure can obviously give us a lot of confluence and ideas with that. For example, this low should be trading up to where the SMDR itself, right? This low to that high, trading into it. We actually consolidated for a while. However, you might actually look at this as a bearish trend. We've got a low, a high, now another low. We would expect to trade into this zone and then put in a new low. So what do we mean by trading against the current objective is we're looking at this movement here, which we're looking at as a retracement to then get short. However, all we've done is form internal structure here. We've got a swing here, we've got another swing there, another swing here, another swing in there, and nothing broken. Now, if we drop to the minute time frame, you can see a lot more information as well. For example, we're trading up here. We have a clear bullish trend, no reason to short whatsoever. We then have some sort of failure. Okay, whether we're able to get involved or not on this movement down that takes this liquidity, we're still in a bullish trend. We're failing to break structure even on our 1 minute time frame. Not a valid pullback here at all. This trades up and now we fail. So any longs after that failure, now we're looking at trading against the current objective. Why? Because we're being told here that the objective is lower below this low, right? So we go down. Obviously, there's no longs here, no longs there. We finally break down, and then we see this reversal pattern. This is the market now telling us that the market wants to trade higher for the same reason that we're looking up here and the market wants to trade lower, right? So what ends up happening is we form a reversal pattern. We trade back in. Can we make a valid high? No. Do we break structure in the 1 minute? Definitely not. We've got this movement down, creating a valid high. We then trade up, closure above here. Therefore, we're still in bullish trend, right? Even though we want to be short, even though this movement is extremely strongly bearish, and now we're expecting anything in here to now go underneath that low structurally. This doesn't make sense because our 15-minute time frame is here, right? With this failure underneath, which we saw earlier. And now this actually fails underneath there. So we've got no break in structure. Our current objective is still bullish. And our expectation is that this high goes and then that 15-minute one. And we'll see how this plays out. Pretty much straight up. Pretty much straight up, right? So we lean on internal structure. Until that's broken, we have no basis to be shorting and trading against what's currently happening. Hopping into mistake number 2, not waiting for something to be taken. Now, this is one of those rules that seems a little obvious. However, the majority of people don't understand, or at least don't trade based off of the idea that the market is either generating liquidity or it's taking it, right? And it's very, very difficult to wait for that, especially when we start becoming profitable and we're not consistent yet, because the market is the best in the world at generating executions without actually taking the objective. For example, if we look at this chart, you can probably already spot what I'm going to put out here, right? We've got this major low. Okay, that makes sense. We've also got the movements that are along the way here. So this is a bullish move. We then have failure below, right? So this high is weak. This movement up didn't take anything to the left. You've got highs here, major pool of liquidity, inside of bullish movement. This movement lower, people were actually looking long. They got long in here, then they got ran out there. Why? Because the liquidity wasn't underneath this or this where these longs were entering. It was underneath these lows here. That got ran out, then the move happens. So what happens? They chase it all the way up. This doesn't take this area here. We come down, we fail. This is called inducement on an intermediate time frame. And now what happens is we run out the liquidity here. Everybody waiting to short, they shorted in here, they shorted all the way over here. They didn't wait for the market to engineer and then take out liquidity before the major movement happens. And you can see that as soon as that was taken out, immediately the market started moving in the direction they wanted. All the way down, we build SNDRs for this exact purpose as well. If we're going to take that low, this is how it's going to deliver. We trade up, we make this high, we trade lower, we take this liquidity, but that couldn't run this high, right? So we're trading against the objective if we're looking long, just like we learned in the last mistake. However, nothing was taken here on the short side. So it's very difficult to get involved in all of this. But you'll notice that once this was taken, we then had a change in order flow. Now we're looking for this to take something on the left. We engineer liquidity here, strong little movement up, then trades finally into our area of interest, failing, and you see a lower time frame liquidity sweep here before this candle closes bullish. And that's when the movement happens, right? Sweeping everybody out, movement happens, right? So wait for something to be taken, or at least understand that the market is generating liquidity to then sweep it out. And that failure lets everybody know that, number one, everybody's been taken out of the market and now the movement can happen. And number two is that the movement down is finalized and now we can continue on our merry way. Moving on to mistake number 3. If you're aggressive in, you better be aggressive getting out. A lower time example now. We've got this high here. We have a pullback. This movement, we see a higher time frame shove. We notice a few different things in here. This failure, we're looking for a body closure underneath this candle. And if that happened, we're likely taking this low and then running. However, we see this failure to close here, leading to a higher time frame shove. That's the market telling us that we're not ready yet. So if we took this high and we aggressively entered on a short, we need to be looking for signs of failure in areas that we would be expecting an unload. Instead, we get held up and we would have either taken a loss, maybe break even, but we certainly would have given up some points had we not noticed that. We notice the same sort of thing on this pullback too. This movement back down to the consolidation, we might be looking for some longs to come out of here. And in reality, this movement here did try and put in a valid low in this movement. That was one tick above this candle. However, we failed and obviously we took that low as a result. That's the market telling us it might want to go up, but it's certainly not ready yet. Now, what happened here was the same sort of thing, except we generated liquidity, we swept it, and now we're trying for another valid low. Instead, we couldn't get a body closure. So if we were taking longs out of this consolidation, looking for this high, and we're not noticing these aggressive reasons to get out based off this aggressive entry, then we would have missed a whole bunch of points, or we would have taken losses on this unload that ended up happening later on. Now, it's important to note that these are all aggressive entries. Had we been looking for a conservative one, we would have been looking for either a valid low being put in and then a retest of that area, or we would have been looking for a change in order flow to then get involved in, neither of which got triggered. So our conservative entries wouldn't have been triggered in at all. Now, this movement lower, we see a break in order flow. Okay, we're looking at maybe trading back into this zone. That didn't quite happen here. However, you do see this price movement. We trade up, we trade down, we trade up, we trade lower, we trade back in. We could justify potential short to take these equal lows. However, this movement up, you'll notice we didn't attempt to make a valid low here. So any longs in here that would have been aggressive, had this not broken above, you would have been in major danger, right? So we ended up getting that sweep. We got a body closure there. Our expectation is now lower prices, certainly underneath this low. Instead, this candle ends up trading up and putting in a valid low here. That's major danger. We trade down, we mitigate this zone, and clearly we go up to take this high. So that valid low is a major warning sign after we've put in a valid high here that we need to be looking for aggressive exits if we're looking at taking aggressive shorts in here. Mistake number 4, unfair expectations of price. Now, what do we mean by unfair expectations of price? What usually happens when traders first come to the pen and we start to mentor them is that they tend to attribute one loss to the next trade. For example, we are clearly bearish in this example that we just left in mistake number 3. And this movement down, any longs that we take, our objective based off of market structure 101 should be to trade into the prior zone, whether that's the Wombo area or whatever else. Instead, what usually happens, we start attributing a loss we took in here because it didn't achieve the objective. We still hang on to that objective. And now what we're doing is we're looking for a long here to trade up, finally. We're looking for, oh, okay, we've got another break. We're now trading back in to go long for that objective as well. Not realizing that we should actually zoom out, and this movement is just going to become a retracement to eventually take this low. Why? Because we're expecting a higher time frame failure in order to have a reversal. Or at the very least, we need some sort of form of break of structure, right? This lower time frame break of structure should facilitate a movement back up into here, which it does here. And now we've finalized our objective and we can finally start heading lower. So these shorts, for the same example, we're looking at this break of structure until this area has been hit. Our shorts are just retracing back down to the current objective, which in this bullish movement is to trade back into the prior zone, right? So we have a protected low here. This trades back in and now leaves, right? Same sort of thing here. This trades back in to where the last swing and then leaves, okay? So we need to temper our expectations based off of current objectives and structure and not worry about the higher time frame objective until we have higher time frame reasons to take it. Brings us to the conclusion, mistake number 5, and this is probably the biggest one. Seeking perfection and missing direction. That sounds a little heavy, but essentially what we're saying is that it's much more important to get involved in the move when it's happening, or at least on the retracement of it and reacting to what price is telling us, rather than sitting on our hands and needing something to trade to the tick. Now, obviously there's situations where if price doesn't hit something to the tick, for example, some certain liquidity sweeps and whatnot where objectives haven't been met, then those become low probability trades. But if we're looking at this chart, for example, clearly we're in a consolidation here. We didn't take this low, and yet we have a higher time frame movement up after we've put in a valid low in this move, right? We have a trade down. We've now put in a valid low here as well. If we're sitting on our hands and we're going, well, I want this imbalance, or maybe I'm looking at this and I didn't trade down into it and it just missed me entirely, we're essentially saying that we don't really understand why the movement should be exploding now after a candle like this and a significant movement away. There's many opportunities of getting involved in here as long as we risk appropriately and we don't end up missing out on the crazy move that ends up happening later on. Now, we go in depth in all of these concepts, both with structure, with narrative and objectives. We go through failure, we go through CRT. All of this is on the free YouTube masterclass playlist. I would definitely check that out if you liked this video. Please let us know in the comments what you thought, and we'll see you guys in the next one.